So when I say corporate finance, what pops into your head? Probably a lot of spreadsheets, right? Maybe some complicated formulas. But what if I told you that at its heart, it's really about answering just 3 crucial questions? Questions that every single business has to face.
Whether it's a tiny corner coffee shop or a massive global tech company, these questions must be answered.
And really, that's the big question, isn't it? Every company has some amount of money. But what's the absolute best way to use it?
Where does that cash even come from to begin with? And how do you manage it day to day so you don't run out? That's what we're going to dig into right now. So here's the game plan. We're going to start with those 3 big questions. Then we'll talk about the single ultimate goal of it all.
After that, we'll look at what happens when people's interests don't quite line up, see where the money actually flows in the markets, and wrap up with the real-world stakes of all this stuff.
All right, first up, finance's 3 big questions. Let's think of this as the financial manager's playbook.
So imagine you're in that role. Your job, plain and simple, is to make the best possible decisions for the company's owners. And to do that, you have to constantly answer 3 fundamental questions. Think of it like this. There are 3 main pillars that hold up every major financial decision a company makes. The first is, what long-term stuff should we buy? That's capital budgeting. The second is, okay, how are we going to pay for that stuff? That's capital structure. And the third is, how do we manage our cash for the day-to-day grind? That's working capital management. Let's take a closer look at each one. First up, capital budgeting. This is all about the big bets, the long-term plays. We're talking about huge decisions, like building a new factory, buying a fleet of trucks, or to use a more modern example,
Should a company like Netflix pour hundreds of millions of dollars into producing a massive new series? The whole game here is figuring out if the future cash that investment will bring in is worth the risk and the cost today.
Okay, so you've decided to greenlight that blockbuster series. Awesome! But where does the money actually come from?
That brings us to our second big question, capital structure. And this is a classic choice between 2 main options.
Do you borrow the money as a loan and promise to pay it back with interest? That's debt. Or do you sell a little slice of ownership in the company to investors in exchange for their cash? That's equity. Getting that mix of debt and equity right is absolutely critical.
And that brings us to our third pillar, working capital management. Now, this isn't about those huge, flashy projects.
This is about the nitty-gritty, the short term, the day-to-day survival.
It's about making sure there's enough cash on hand, right now, to pay your employees' salaries, to keep the lights on, to pay your suppliers on time. And if you get this wrong, even a company that looks profitable on paper can go bankrupt.
So, we know the 3 big questions a financial manager is always juggling. But what's the point of it all?
What is the one single, ultimate goal they're trying to achieve with all these decisions?
Now, you might think the answer is obvious, but trust me, it's probably not what you're thinking.
Your first instinct is probably maximize profit, right? I mean, that makes total sense. But as a goal, profit is actually kind of fuzzy.
Are we talking about this quarter's profit or profit 5 years from now? And it totally ignores risk.
You could take a huge, dangerous gamble to boost profits this year. Plus, profits can be played with through accounting tricks. On the other hand, maximizing the company's stock value? Well, that's a much clearer, more solid target.
It forces everyone to think long-term and automatically bakes in the risks and timing of all the cash flows.
And there you have it. The one true north for financial management inside a corporation is to maximize the current value per share of the company's existing stock.
It's a single number updated every second the market is open that reflects everything the world knows and expects about that company's future.
It's a single number updated every second the market is open that reflects everything the world knows and expects about that company's future. So why is this specific goal so powerful? Well, think about all the people a company has to pay. Its suppliers, its employees, the banks it borrowed from. They all get paid first.
The stockholders, the owners, they get whatever is left over. They get the residual. So if their piece of the pie is getting bigger, it's a really strong sign that the business is healthy.
But you know, this focus on the owners leads to a classic conflict. What about the managers who are actually running the company every day?
Their personal interests might not perfectly align with the owners. And this creates something we call the agency problem.
You've got two main players. The stockholders are the owners. Employers, they're the principals. And they hire managers, the agents.
But here's the rub. While the principals are focused on making their investment grow, the agents might be more worried about things like their own job security.
And this conflict isn't just theoretical. It has real, tangible costs. You've got direct costs, like a CEO demanding a fancy private jet.
But the indirect costs, that's where things can get really damaging.
This happens when a manager passes on a risky project, all because they were afraid to fail.
So how do you solve this? It really boils down to a classic carrot and a stick.
The carrot is stock-based pay.
Suddenly, everyone's on the same team.
And the stick? That's the threat of a takeover. If managers do a bad job, another company could swoop in.
We've been talking a ton about stock price. But where is that price actually decided?
It all happens in the financial markets. But it's really important to know that these markets are split into two very different types. First, you have the primary market. This is where a company creates and sells brand new shares.
The cash goes directly to the company.
Then you have the secondary market. It's where you and I trade all those existing shares back and forth. Let's use a huge example to make this crystal clear. Think way back to 2012, when Facebook had its massive IPO.
They sold their new shares to the public for $38 apiece. They then used that mountain of cash to hire more engineers, build those giant data centers, and grow the business. That's the primary market in action.
It's how companies raise capital to get bigger and better.
Now, fast forward to today. If you go on your phone and buy a share of Meta, which is Facebook's parent company, Meta itself sees none of that money.
Zero. Your cash goes to whatever other investor was selling their share at that moment.
The secondary market is what provides liquidity for investors and sets that all-important stock price, but it doesn't directly give cash to the company. We know the market sets the price, but that market doesn't operate in a vacuum. The price of a stock doesn't just reflect a company's performance.
It also reflects the entire ecosystem of rules, laws, and ethical standards that the company has to play by. A perfect example of this is the Sarbanes-Oxley Act, or SOX for short.
This law came about in 2002 after some absolutely massive accounting scandals.
And it was designed to force companies to be way more transparent and accountable to protect investors. But here's the thing. Complying with SOX can be incredibly expensive.
So much so that some smaller companies have decided it's just not worth it and have chosen to leave the public stock market entirely.
It's a classic trade-off. And this all leads to a really crucial point about the link between ethics and finance.
That goal of maximizing shareholder value can sound a little cold or even greedy to some people. But here's the reality. You simply cannot build sustainable long-term value on a foundation of lies and unethical behavior. Eventually, it all comes crashing down in the form of lawsuits, fines, a ruined reputation, and a collapsed stock price. So in the long run, acting ethically isn't just a nice thing to do, it's an absolute requirement for achieving that financial goal.
And that leaves us with the biggest, and maybe the toughest question in all of modern corporate finance.
If the number one job is to maximize value for the owners, the shareholders, how does that square with a company's responsibilities to everyone else? To its employees? To the communities it operates in? To the environment? This is the central tension that defines so much of business today. And believe me, there are no easy answers.
This tension between profits and people isn't going away. It's the debate that is going to define the next decade of business.
And now that you know the framework, the 3 questions, the ultimate goal, and the real-world stakes, you're ready to dive deeper. If this helped you make sense of the madness, hit that like button and subscribe so we know to make more.